Hello everyone, so welcome to another video. My portfolio has crossed the milestone of 5 crores in current value, and I wanted to use this opportunity to document my journey so far and also share my plan with you of getting from this 5 crores to 100 crores. We'll cover all of the mistakes that I've made on this journey, how much money I've booked in profits, what's my XIRR for people who are curious, and also the numbers from here on, from the age of 35, which is my current age, to getting to 100 crores in equity. So let's get started. First of all, I want you to look at my top holdings. Now, this is all of my holdings, including the mutual funds. Around 60% of all my money is in the index. So we're looking at Midcap 150, which is my biggest holding, then the next 50, then the Nifty 50. Those are my top 3 holdings. So basically these 3 allow me to invest in the top 250 companies of India. The first 50 companies of India is the Nifty 50, then the next 50 is the top 100 companies, and then the next 150, which are the mid-cap companies. So it's not a fancy portfolio. It's a very simple portfolio. I'm moving to a more and more simplified version of the portfolio. I made a video recently that I've sold most of my individual stocks that I was holding, and I'm not actively investing in any of the active mutual funds anymore. So you'll see over the years, these are the 3 holdings that will keep taking up more and more volume and weightage in my portfolio. So as of now, you see the total P&L is around 1 crore 12 lakhs, so 1 crore plus. For those who are curious about the XIRR, it's around 16.79%. So I've been investing for more than 5 years, almost 7 years by now. And this is going to be the overall return of the portfolio. For those who are not familiar with XIRR, if you have to understand it versus something like a CAGR, the analogy that I like to use is think of a plant in a garden. If you put a plant and it grows at a certain rate per year, that's a CAGR. But the growth rate of your entire garden, when you put in different plants and then take out the fruits and vegetables and keep putting back in new plants at different dates, that's your XIRR. So XIRR actually shows you the real growth rate of your portfolio. Now, just to compare with the index, the Nifty 50 typically returns at 12%. But the important thing to understand here is I'm not trying to beat that. In fact, my calculations of my enough number, my financial freedom number are all based on a 12% return. So I'm not trying to say that I'm better than the market, because especially as an index investor, I just want to chase the index returns. I just want to say that if India is growing at this rate, I want to grow at that rate. India is going to give me back 12% is what I'm assuming, right? So now you can see my portfolio performance, compare it with Nifty 50. Of course, there's going to be slightly better performance of my portfolio than Nifty 50 because my portfolio is a composition of Nifty 50 plus Next 50 plus Midcap 150, which definitely drives better returns than just the top 50 companies of India. So this is my portfolio NAV versus the Nifty 50, right? So where Nifty 50 has been up 60.81% in this period since 1st of July 2022, my equity portfolio has been up in absolute terms 86.73%. However, if my portfolio had to benchmark at the Nifty 50 level at 60.81%, I would be as happy, which brings me to the next point, which is the most important metric that I'm personally chasing or paying attention to is the amount that I've invested into the market. That's the only metric that I can control, because my returns are going to chase the market. Whatever the country gives us, I'm going to take that. But in terms of the invested amount, this is where I'm playing the game, right? So how did I make this money? I have a digital marketing agency. I started freelancing in 2009 while I was still studying. So I started really early. I'm 35 years old now, and I have diversified my income streams. I have my agency business, and I've made a separate video on all of my income sources. I have affiliate income from tools and resources that I refer to my agency clients. I take up consulting projects, and those all make up my income streams, which has allowed me to make this money and invest it into the market. Now let's go into the booked profits, because this is another question that people ask. We're not going to go into dividends, though I do receive dividends from the individual stock holdings that I had in the past. And I had done some swing trading before 2020. So that was more than 5 years ago. So what we're going to do is, just to simplify this report, we're just going to look at the last 5 years. Over this 5-year period, I've booked around 33.63 lakhs in net realized P&L from a 35.09 realized P&L. So you remove the charges and taxes, and then you're left with this much, which is 33.60. I believe this is more than 50,000 a month if you calculate it monthly. Now, this could be because of change in investing strategy. I moved from actively managed funds to the index over time. I stopped swing trading somewhere towards the end of 2020. Maybe some rebalancing here and there, which is something I don't want to do a lot of. So not something that I'm super proud of. There have been a few instances recently where I have booked profits. Now, this particular thing, which is on September 5th, I have documented in my previous video, is the time when I sold a lot of my individual stocks and I took the hit for taxes. So this is also the reason why I don't buy any new individual stocks, so that I don't have to pay tax and I let my portfolio compound over time, because that's the most important thing for me, that the portfolio keeps compounding over a long period of time. Right? So those are all the metrics. Those are the top holdings. The index investments make up for most of my portfolio. So if you look at the index, around 2.43 CR of this money is in the index investment. So that's majority of my portfolio. If you look at the split, 60% plus is in the index. 16% is still in mutual funds, though, like I said, I don't have active SIBs in these funds, but I'm going to continue to hold on to them for now, right? In terms of the small cap, I was majorly investing in the small cap using active mutual funds, but now I have started buying the small cap ETF as well. So I think as I'm getting more mature about investing, I'm just putting more and more money into the index and ETF, because I don't want the decision fatigue of seeing which small cap fund, because with small cap, I was still stuck in that mindset of, okay, there's going to be a better fund, right? So if my fund is not performing as well as a new fund, then what should I do? Maybe it's not underperforming for a few years, but when I invest in the index, I know, okay, if small cap as a category, it's going to perform, my index is going to perform. And there's definitely going to be years when small cap as a category doesn't perform and my portfolio may not perform in those years. And I'm ready to take that hit in those years because I am a simple index investor. It's more of a mindset than a percentage return. It gives me a lot of peace of mind, which is the real metric that matters more than anything else, right? And then the metals plus sectoral, there's only one sectoral fund I have, which is the consumption ETF. And I believe that consumption in our country is just going to keep increasing over time, as has happened in any developing economy, which goes from a developing to a developed economy, right? And then gold and silver, some STBs, all of that together is around 12% of this equity portfolio. Now, the next 5 years, if you assume the portfolio compounds as a 12 to 14% annually, this can easily hit 9 to 10 CR in 5 years. My goal is to also try to double the portfolio every 5 years, with, of course, some additional investments going into the portfolio. But first, we're going to look at the numbers based on the rule of 72, which is 72 divided by annual return rate is the number of years it's going to take to double your portfolio. So if your return rate is going to be, let's say, the Nifty 50 average return rate, which is 12%, India is giving you 12%, Nifty is giving you 12%, it's going to take 6 years for your money to double. Now, if I get a 14% with my next 50 plus Midcap 150 kind of a composition of portfolio, it may take 5 years for my portfolio to double. And then if I can even accelerate it, let's say with small cap exposure and so forth, you'll see 72 divided by 16 is 4.5. Now that's just the math. In practice, what happens is going to be, of course, slightly different. So we're going to calculate at all three bands. Now, again, I haven't forgotten about our best friend inflation, and inflation happens. But since I'm targeting a 100 crore portfolio and I've already hit my enough number, which is 8.5 CR in total net worth, not just in equity, I'm kind of happy to take that as, a decent milestone. I know inflation will kill some of that 100 crores, but I'm happy with that, right? So that's my whole perspective, because I've already hit my enough number and my money will continue to grow, right? So at some point, you'll have to give yourself some room to breathe. Otherwise, there is no math or there is no calculation that's ever going to make you happy, right? So age 40, 5 years from now at 12%, approximately 9 CR, approximately 9.6 at 14%. And then I'm looking at 60, which is 25 years. I'm going to hope to get to 100 crores when I'm 60, right? This is all assuming that we're not putting any new money into the market. In this table, we've assumed 12%, 14%, 16%. If we go with a blended TRI, which is the total return of the index, including all of the dividends and everything, over the next 15 years, I've assumed 12%, 13 to 14% for next 50, plus Nifty 50, 14 to 15% for Midcap 150, and then the blended around 14%. So if you go back to the table at the 14%, well over 100 crores is what, the calculation comes to be. Now, let's say if I hit my goal, which is to double my portfolio every 5 years with additional investments, then from now to 60 years, I'm looking at a 160 CR, right? So if I continue to invest, now I could stop investing today and still hope for a 100 crore at 60. And I might actually do that. Like, for example, this year, I'm not taking any active work. So I'm not really working this year. Probably the next 2 years, I may not work. And that's because I'm just focused on parenting right now. I will make these YouTube videos from time to time, but not actively chasing money, active client projects, which is where the most ROI of my time investment is going to come. I feel that the bigger ROI on that is now with family, because I've hit the enough number. I think the ROI of spending a lot of quality time and giving love and attention to children before they turn 6 is the highest ROI activity that I can do in my life right now. So that's what I'm focusing on right now. My wealth bucket is filled enough that I can focus on just my health and family. Those are the 3 buckets of my life, right? So when a bucket fills, you can either overflow it by over hustling, doing more work, making more money, because there's definitely no end to how much you can overfill a bucket, right? Because it will just keep flowing out and you wouldn't even know that it's flowing out until it's too late. So I want to stop there. I want to focus on my health and family as much as possible. So at least the next 5 years, because this is the phase when the children have this concept from Montessori called the absorbent mind, where they will absorb everything they see in the environment. This is the time that you can shape them. This is the time when there is never enough love that you can give them. So this is what I want to prioritize in this stage of life. But if I had to keep investing and double my portfolio every 5 years, put in some effort from my end to do that, by 60, the calculation comes to well over 100 crores. Now, these calculations, there might be a small issue here and there based on what numbers you've assumed and this and that, but it's well over 100 crores, right? So simple tips: build a boring automated investment plan. If I had to start over again, I'd probably just invest in Nifty 50 for the longest period of time. Probably after I have 1 crore, I might add like a next 50. After I have 2 crores, I might add like a Midcap 150. Maybe at 5 crores, I might have my first rental property in terms of overall net worth. Like right now, even if you look at my current portfolio split, it's this 5 crores, which is in equity. Then I have around 2 crores or so in real estate, but that's not in India. And now I am planning to make my first real estate investment in Bangalore, in India. So that's just something that I have in the plans. And that's happened now after hitting 5 crores in equity. So I'm a majorly equity investor. I do have the gold and silver as I've shown you, and I have around 1 crore sitting in US index through my Singapore company, right? That is how I've diversified my portfolio. Now, in terms of tracking, I think this is one of the most important things that I've done, and this is actual data of my net worth over the past years from 2017 to 2025 Q1, so which was 8.5 CR at that point of time. And I started tracking when it was 12 lakh rupees. And I've seen the curve. I've seen the magic of compounding. Compounding is not something which is just, some magical mathematical equation. It's just very hard to visualize, which is why we sell, which is why we chase short-term goals. There's this concept of finite games and infinite games. When you start switching your mindset in investing of playing infinite games, that's when you start winning. Because if you were thinking of this as a finite game, you would think of it as a short-term win. You would think, what can I buy today to get a few thousand rupees next week, right? But I'm thinking of this as an infinite game, because most of the important games in your life, your health, wealth, family, are all infinite games. Then you switch your mindset from finite games to infinite games, I think beautiful things happen in life. And while keeping the essentialist approach in mind, where I keep my investments very, very simple, right? So tracking gives you an overall picture of what are your assets, what are your liabilities, and your assets minus liabilities is what you have left, is what makes your net worth. There are people I know who make a lot of money with zero or negative net worth. There are people I know who make not as much money but have a high net worth. Like right now I have zero active income, but my net worth is over $1 million, right? So start tracking your net worth. I will also include a link of the net worth tracking template that I use which is on Google Sheets, and you can start using that template. It's a free template, and then build up on top of that. So that's another lesson that I would share. Try to create a monthly surplus. Whether you are in a job, try to get a raise in your job. If not, start freelancing. Build at least one additional revenue stream. Make money. That's going to be the most important thing. It's not about the stock you pick, the fund you choose, and so forth. And a lot of people say in my video, because you have so much money, you can just keep your investing simple. But if I wouldn't have so much money, I will have to trade. But the problem is that most people will lose in trading, and you cannot consistently win it trading. But if you develop a skill and provide that as value to another person, whether through freelancing, through a product or a service, and you can make money in exchange for that, that's going to give you much better returns. You can start a business and get 200, 300% year returns versus any stock pick that you can buy consistently. Do that for years to come, right? So that's an important thing. Do something that you can play that game for an infinite period of time consistently well. And that's definitely not trading for 90% plus of people, which is what all the data shows as well. Next, let's see the biggest traps that you can fall for, right? So lifestyle creep. People get more income. The first thing they do is they increase their lifestyle. Now, I'm not saying don't spend the money, but spend it where it matters more, like invest or spend in experiences. That's going to create memories. Memories also compound over time. You can spend it for your health, for your wealth, for your family. If you know your priorities, and maybe these are not your priorities, your life pillars could be very different from mine, but if they add value to your life pillars, definitely spend the money there. If spending the money can increase your skill level, which is going to help you make more money, you can then invest there. If you want to invest in your learning, if you want to get fitter, because that's going to help you operate at a more productive level, invest there, right? I think that chasing an extra percentage of return from the market is probably not the smartest thing to do, but chasing those percentages of return from yourself and then investing in a low cost index in the market is probably going to give you much better long-term results. You will avoid the FOMO of social media. You can actually skip all of the content around personal finance on the internet if you start investing in the index. And that itself frees up a lot of time and energy in your life to do something like skill development. Last thing I want to say after talking about all of these metrics and numbers is design your life around freedom. What matters is what that money serves as. Now, the money is sitting there in my portfolio. It's not doing anything for me. I don't need a fancy car or anything with that money, but the purpose it's serving is the backbone. It's giving me the freedom that's allowing me to focus on having a simple life, simple routine with my family, and focus on my family and health. So that's what I want to leave you with. I hope you enjoyed this video and learned something from my journey. If you want to keep seeing more of my videos, make sure that you subscribe to this channel and turn on notifications. Thank you so much for watching. I'll see you in the next one. Bye.